special guest that's part of Hustle the Net, Chelsey Abrams, who will be sharing with us tax strategies that not just business owners should be using, but actually people who don't even have a business yet. You're going to learn strategies that, if you just open an LLC, you could utilize. And there's a lot of things that the average person can take advantage of that they probably don't know about. But I'm going to stop talking. I'm going to turn over the floor to Chelsey. And Chelsey, once again, I thank you for doing this and sharing this information with everyone.
Everybody, thank you, Travis. Today's topic are taxes 101. So it is a lot of information, but we're going to do a brief overview of everything. Make sure you guys are set up, and as we go on, we can start to dive into some of these topics specifically. So I'm going to just jump right in. I'm going to share my screen here. So taxes 101. So I'm going to first start off with the financial history. Taxes actually really did not start until the 1900s. There were some taxes that were proposed during the 1800s, 1700s, but as far as the inheritance tax, federal, state, and state started doing taxes in 1900. So in 1913, that's when income taxes were permanently legalized. Before then, there were no income taxes. In the 30s, states began collecting sales tax. That was shortly after the Great Depression. Social Security taxes, the first tax for that was taken up in 1937. Great Depression, at the end of the Great Depression, tax rates were at the highest. So it was in the 90%. So we'll see that in the next slide a little bit more. They dropped a little bit, but taxes were running high through the 1970s. And that's when the IRAs and 401ks were created to allow tax deferrals. And then where we are right now, with 2018, the TCJA, or the Tax Cut and Jobs Act, that was done. There are a lot of things that we're seeing, and they are particularly beneficial for entrepreneurs. So tax history in America, as we see, 1913 is when it started. Where we spoke in the 1940s, we see that it's near 90%. So it was there for quite some time in that range, and that in between 80 to 90% from the 40s to about the late 60s, early 70s. And then we start to see it go down and come down further and further to what we know today. So 2020 tax rates. This is just a chart that we have. This source is from the IRS, and CNBC also published this. Individual tax rates start at 10% to go up to 37%. One thing to note, corporate tax rates, because I'm sure a lot of people are like, oh, I heard tax rates will drop to 21%. That's to the corporation. So if you are not a corporation, it is in this 10 to 37% range. But we still have FICA, which is Social Security and Medicare. And the Social Security part goes up to $137,700. Medicare, the 1.45% continues on. Then median state tax is 7.5%. So the range for state taxes is 0% to 13%, which is where the median of 7.5 comes from. And that's a total tax on the low end of 25.05%. So a quarter of your income off the break is going away in taxes. So my sister's like, can we do an example? I said, sure, you'll be our example. So this isn't really her situation. She's definitely making her life more tax savvy, but in this example, doctor now makes $100K gross income per year. She's employed. She's not self-employed. She works for someone else. She doesn't have a house. She doesn't have any other tax deductions. So she takes the standard deduction for a single person, which is $12,400. So right there, it's $87,800 that's taxable. Federal tax rate as we saw this slide before, for that range, and just so you guys can see, let's take a look. For the 87,000, this right here is at 24%, right? We're just going to go with the median state tax of 7.5, FICA of 7.65. That's a total tax of 39.15%. So that means net income after tax is 65,825 or 5,480 monthly. So that's a big jump. She went from making 100,000, or thinking she was making to 100,000, to actually only having $65,000. This doesn't include health care or any like retirement deductions or anything like that. So this is just one of the things to consider. So the next question I'm sure people will probably want to know, how can I save on taxes? How can I reduce this number? How can I make myself more tax efficient? So a lot of us are here because we do want to be tax smart. We are entrepreneurs. We're in that business mindset. So one thing that we want to do is make sure we're doing our record keeping, strategizing, having a tax plan. The plan should not just start when you're about to file your taxes at the end of the year when the year's over. You really should be, 2020 tax planning should have been done in 2019. If you haven't done it, it's something you should do now. How many of you guys have done your tax planning? Anyone?
Negative, boss.
Nope.
Okay. So we need to jump on that because those are things that you need to consider before the year's over. If you know before the year's over that, hey, I'm going to be in this tax bracket, I need to do X, Y, and Z to decrease my bracket. Maybe you're on that line. You know that you need to do it. Or if just whatever the case may be. Those are things that you need to consider. Knowing your tax structure. So there are different tax structures. You guys can be sole proprietorship, which you will get taxed out the wazoo. You could be an S corp or an LLC taxed as an S corp. Partnership, a C corp. So they're different things. And remember what I've said. C corps have a lower tax percentage. So the tax awareness. While I know a lot about taxes and about finances and accounting, I do not know everything. If you have a farm, I don't know much about farms. I cannot tell you all the tax deductions. I'll look it up, I'll research it, I'll help you out. But if you ask me a question, I'm not going to know it because that's not my area. I'm not a farmer. I'm not really into agriculture, and none of my clients are. So be aware of your area of business so you know things that will benefit you. And you bring that to your accountant and say, hey, well, I read here this, or this is something I was talking to someone. Just ask questions. Make sure that you're making yourself aware of what is going on and your options. So, home-based businesses. There's so many benefits with home-based businesses. These are just some of the things that people got with the home-based business. So there's a tax code that says anything that is ordinary and necessary to deduct in your business, like for you to kind of do your business, is tax deductible. So what are some things that you guys may have or think of that might be ordinary and necessary in your different businesses?
Vehicle.
Say it again? Vehicle. What else? Accounting. What else?
Website. Oh, wait, that's not ordinary, but
No, website is ordinary, right? Don't businesses have websites?
yeah.
So I have a client, she asked me, so she's an event planner, and she does stuff a lot in the political realm, so she had to do fundraisers. That's a part of what she's doing. She said, well, I had to do this event. Is my gown and my hair tax deductible?
Yes,
What do you
it
think
is.
the answer was?
Why, yes, it is.
Yeah.
Anyone? Any guesses?
Yeah. Oh, yes.
Yeah, it is. Definitely. So that's something, because she's not just walking around in a ball gown on a normal basis. She can't be the face of a fundraising event that she's helping to throw and doing her job and not look the part. for the fundraiser. And this is part of the job that she had. So that is actually ordinary and necessary for her job. I was reading another blog on one of the other tax experts that I follow. I kind of look to when I'm doing different research as well. And she had a client. You guys, she's got in the background. But she had a client who had a yacht, $1 million yacht, and guess what? She was able to make that tax deductible. Why? Because she was in real estate, and she would show her clients the real estate on the water. She's like, the best way to sell a waterfront property is to take their clients out on the water. And it was ordinary and necessary, and she did that with a lot of her clients, and she was able to write the yacht off. So I want you guys to think about that and remember these things when you're thinking about expenses and things that you could deduct with your businesses. So there's also qualified business deduction for small businesses where you're getting a 20% deduction off the break. So lunch and dinner meetings with clients and colleagues. While there are no options to do 100% of this, if it's just like a dinner meeting, you can still do 50% and sometimes 80% deductions. Now, a way to kind of get around this is if you are, let's say you're a caterer, then the food is 100% deductible because that is actually a good that you're using for the food, for your service. So travel expenses. If you have to go away for a business meeting or for a seminar. And one, I guess, key to know here, if you have a meeting in Hawaii on a Friday, and then you have another meeting on Monday, would you go back home? You have to stay there on the weekend. So now this trip to Hawaii that you have a meeting on Friday, you're there on Monday, you have to stay over the weekend, and you have the meeting on Monday, maybe there's like some type of a gathering, a networking event on Tuesday and another one on Wednesday, that entire trip has become tax deductible. Now on the flip side, if you have the meeting on Monday, Tuesday, Wednesday, but you go Friday and stay over the weekend, then a portion of your trip is no longer tax deductible, but you're able to still deduct a portion of it. So really think about these things too. So that goes back to the planning. So professional services, I heard someone say accounting, so legal, marketing, other consulting services, they're all tax deductible. Healthcare premiums, tax deductible. Liability insurance is tax deductible. Website costs, tax deductible.
Makeup.
So this is not a complete list, but it's a list for you guys to consider. Okay. Huh? Say that again?
I said, like, you're talking about makeup or things.
Any questions so far? Yeah, other miscellaneous expenses. So I'm gonna actually hop back to address this a little bit more. We'll look at the home-based business. We have cell phones. We have the internet. Your utilities. So your home, a portion of your mortgage is tax deductible, or the space that you use, or rent is tax deductible. Then the internet, your utilities, supplies that you get, your furniture for your office, your computer, business magazines and stuff that you may use. These are all things that you need to consider that are tax deductible and will lower that tax liability. So, tax
Chelsey,
tips. Set up your retirement account. Yes.
I just have a question about some of those things that you went over. Can you hear me?
Yes.
Can you hear me? Okay, I think my internet.
I can hear you.
So I have a question about some of the things that you went over. Yes. Some of the things that you went over related to your home business. Given the current scenario of COVID and most people are working from home. Does that apply in any way to these people under this unique circumstance?
So, it used to. Before, if you had a space that you work from home and you were an employee, you would be able to get a tax deduction. There were other things that you could do as employees for tax deduction. The TCJA eliminated the employee tax deductions. So, as an employee, no, but as a business owner, yes. Does that answer your question?
Yes. And I know you said one of your slides had something about insurance premiums. Could you say a little bit more about how those are deductible?
So it's not all insurance premiums. It's health insurance, it's liability insurance. Now, if you are talking, and then I guess there's certain other key insurances that may be deductible, but you have to kind of really understand what the purpose of the insurance is, if it can be deducted, and whether or not it will be taxed later. But for the most part, if you think liability insurance, if you think health insurance, insurance that you need to kind of keep your business going and protect you, those insurances are tax deductible. Does that make sense?
Yes. And so, just wanted to be clear, the health insurance premiums that are deductible are for those expenses related to your own and not as an employee. Sorry.
Yes. These are for business owners and not as an employee. Because when you think about it as an employee, if you have your your health insurance is taken directly from your paycheck, that's pre-tax. So, as an employee, different things that are tax deductible are, or I'll say pre-tax items, like 401ks, contribution. You'll get FSAs or HSAs. Those are also tax deductible, are pre-tax, so they won't be included in your taxable income. Healthcare premiums won't be included in your taxable income as an employee. So those are already taken out when they give you your W-2. So you can't get an additional deduction on those things.
Okay, got it. And did you say anything about life insurance policies?
Not with this. Life insurance typically is not tax deductible because you are able to get the proceeds from life insurance after that. So that I will kind of touch base on that shortly, because that's also an area that I work in. So we'll touch on life insurance and how that is a good way to build tax-free wealth in a few slides. But
Thank
that's the question. You guys keep them coming. I like the questions. It's good because it makes sure that you guys are getting what you need from this. So please feel free to jump in with questions at any point. So thank you, Nancy. All right, so tax tips. Make sure that you set up your retirement accounts before year end. Now, you do have until, I guess, the tax filing deadline. So this year, it's July. You can make contributions into your retirement accounts, but setting them up before year end so then you can contribute into them. Okay. I mentioned this earlier, but tell your CPA everything that you bought that could be related to your business. I bought a drone because I thought it would take really good pictures, and I'm using those pictures on my website. Tax deductible. Know your goals. So with this, I tell people a lot of times, you have to understand your goals. Of course, the goal is to pay our fair share of tax and not pay more tax than we need. But at the same time, if you're trying to buy a house, understand that they're looking at your taxable income and not just your gross income. There are a couple things that they may add back, but majority of the time they're looking at your taxable income. So you may not be able to write off everything if you want to show them, hey, I did make this money and I didn't just write everything off. But so know your goals. So download a mileage and expense app. There are a ton of them out there. Download one. It will make a difference because tracking your mileage is key when doing your taxes, especially as a business owner, because you get deductions for that. And then also the expense app. A lot of them take pictures. You can take pictures. You can even put your revenue on there. You can do everything from these little apps now. So determine how your LLC should be taxed before year end. So earlier, I mentioned LLC, and you could do a sole proprietor, or it could be a S corp, or be taxed as a partnership if it's a multi-member LLC. I understand how you're going to be taxed before year end, so you make the best plans. One of the biggest differences with being taxed as a sole proprietor versus an S corp. As an S corp, you're able to give yourself a salary, which limits the FICA that you pay. The rest of them will just be at ordinary tax rates without the FICA. But if you're a sole proprietor, you have to pay FICA on that. And you have to pay both sides, not just the 7.65. The 7.65 times 2, because you have to pay the employer and employee side. So at that point, your tax rate goes a little closer to 50% in the example that we had earlier. So consider paying your spouse and your children or your siblings. Consider paying someone in your family for some things that they do to help you. Doing that, you're able to kind of transfer the income to them and change the tax distribution. And then you can also, another way with that in paying your spouse, because if you're filing jointly, now your spouse is able to do contributions into a retirement account. So maybe you guys may be able to put more money away and kind of do a tax strategy based off of that. So prepare for next year. We talked about this a little earlier, but preparing for the upcoming year and not waiting until you're about to file your taxes to figure everything out. And proper record keeping. There's so much free software out there. Then there's also Excel. Just make sure you have a good idea of what it is that you need so you can be most efficient. Okay. So we're going to jump into investments and taxes. These are things that are taxed always, or taxed now. I say taxed always because anytime you get income in these accounts, you're getting taxed on it. Then you have tax deferred. So you don't pay any tax on them now, but you will pay tax on them later. And then tax advantage. You pay tax on them up front so that it can grow, do whatever it does, and you never have to pay tax on them again. Or a couple of them, you never pay tax on them. All right. So the tax now items, you have the savings account, CDs, mutual funds, stocks, things that we know. If you guys notice, real estate is in all three columns because you can, depending on what you're doing with the real estate and how you're operating with it, if you're doing a fix and flip, so if you're just fixing and flipping, you're going to be paying tax on that upfront because it's seen as ordinary income. Now, if you have a buy and hold and then sell the property, you may be able to defer it. And you can defer it indefinitely. We'll get into that a little later. And then for the tax advantage, there's something called opportunity zone funds. And then also the primary resident exemption, I'll call it, where we'll get into that a little bit later, but you're able to not pay taxes on certain gains in both instances. So, being with tax deferred, we saw the tax rate earlier, right? It went up and went down and went back up. It's went around. It's done all these things. With the tax deferred account, know that you're making a contract with someone, aka the government, and you're saying, hey, you know what, I'm going to have this money, I'm going to grow this money, and you can change the rate or the percentage that you get at any time when it's time for me to cash it out. So you can't cash that out until 59 and a half. So 20 years down the line, it's time for you to get your 401k out, and you're ready to pull this money out. You have $100,000 in there, and you're like, yes, I'm going to get this money. And, or let's say $1 million, because you want it to grow to $1 million. You have $1 million in your 401k, and the government says, well, the tax rates are now 50%. You only have $500,000. All that money that had grown, you only get half of it, because that's the tax rate. And a lot of times people are like, oh, when you're retired, you'll be in a lower tax bracket. I know so many people who are retired and they are making more money than they thought because they are getting Social Security, they have a pension, they put some money away in one of the three, like the 401k or 403b or TSP. They've done stuff like that. And they now are making a lot more money. And they're getting taxed more because a lot of times they don't have any deductions. So, my favorite category, and my sister's favorite category, for now you can kind of jump in as you need, but the tax advantage accounts. So, you have like a Roth IRA or 401k, and this is limited to how much you can put in. I believe it's around $6,500 right now for the Roth IRA. The 401k, I believe it's similar to the regular 401k. You have cash value life insurance policies, so that is one of the things that you were talking about, Nancy. I'll show an example of that. But with these, you have like IULs, you have paid up premiums. There are different things that you can do with life insurance that allows you to grow your money tax-free. So HSAs and FSAs, health savings accounts can be invested into the market, and they don't end after the year. So FSAs, at the end of the year, but once again, you don't have to pay taxes on it. If you have medical bills coming up, you put the money on the FSA and you're able to kind of spend that. 529 plans for education. They have to be used for education, but if they are used in education, that's tax advantage. So non-qualified annuities, once again, it's something you paid the tax up front. You're able to grow it, pull the money out tax-free. And then real estate, we kind of touched on that already. So, questions? Anyone? Okay, I'll keep going. Okay, so taxable versus non-taxable investments. I've had this discussion with people. They're like, well, I don't know about this. I think I just want to play in the market. I'm like, okay, that's fine. Things to consider. A 30-year-old female invests $500 a month for 30 years and a 6% annual return. I said this is invested in the market at the 6%, and this one is an IUL. So they're both showing at 6% for a 30-year-old. So she invests for 30 years, $500 a month. At the end of the year, she has a balance with her stock account. $487,256. $487,256. That's pretty good, right? 500. She contributed 180,000 and grew 307,000, and she has 487. Then, in this one, at the end of the 30 years, she would have 381,425. This is taxable. This is not taxable. Which one would you guys prefer? Anyone?
One's not taxed.
You said the one that's not taxed?
Yep.
Anyone prefer the 487? You think the tax would be lower on that, and you would still have more than the 381?
No.
All right. Smart group here. So just using a 25% tax rate, and we saw that the tax rate is they could definitely be higher than that. This is not going to be, you're not going to really have as many deductions on something like this. It's not a business, so you can't deduct from it. 25%, the after-tax amount is $365,000, whereas the non-tax is the $381,000. So you have a little bit more. And with different products, with different life insurance products, they move with the market. So if the market does 10%, your life insurance policy is going to do 10%. So as the taxable amount goes up, typically the IUL goes up as well. Things to consider. So another thing that people have the option to do is do a Roth conversion. So there's no conversion limit. And do you guys know what a Roth conversion is? Do you guys want me to get into that, explain that a little bit more?
Yeah.
Okay, so we all have access to put money into our 401k. We also have access to put money into a Roth account. But the Roth phases out starting at around $122,000, completely phased out around $139,000. And that's the money that we're allowed to put away to grow tax-free. They also only limit us to $6,500, so you can't put a ton of money in there. If you have like $15,000, you can put the $15,000 into a traditional 401k. You cannot put it into a Roth. So, with a Roth conversion, it allows you to take the money that you have in a tax-deferred account, pay the taxes on it, and backdoor it into a Roth. So now this money can grow tax-free. Does that make sense?
Yep.
Okay. So advantages are there's no conversion limit. If you have $100,000, you pay, typically it's like 20% tax. You put the 20% tax, they'll true it up to whatever the amount that you need to pay. And so you pay the $20,000, you can actually still move over the $100,000. You don't have to move over $80,000. You move over the $100,000, just pay $20,000. Right? So there's no conversion limit. There's no modified. MAGI means modified adjusted gross income. So the 122 and the 139, you don't have to worry about it, but you can make $5 million and you can still do a Roth conversion. It grows tax-free. Needs no further explanation. You can withdraw your contributions without penalty. So if you put $100,000 in, you can pull $100,000 out. So I always say this is a good way to kind of do an emergency fund, right? Instead of letting it sit in a bank where you're getting less than 1% interest, maybe 1% interest per year if you're lucky, you can have the money and start building your Roth account. So now it's growing. It's gaining interest. My Roth account in the past month has gone about 25-30%, just with everything going on in the market. But if I needed to, I can go and pull out some of my contribution in case of an emergency. But if not, it's still growing. And I'm able to kind of make that money work smarter and harder for me, opposed to just letting it sit in a bank account where I would be making no money on it. So there's no required minimum distribution. So with a 401k and your other tax-deferred accounts, now it's age 72, you're required to take the distribution. Now, with a Roth, you can just let it sit in there. The government's already gotten their money, so they're not going to force you to take it out. It's transferable. So that means that you're able to take that, and you can leave it in your will and transfer it to your heirs or to whomever. So disadvantages, you do have to pay tax at the time of conversion. Once it's withdrawn, interest is not accrued. So if you pull the money out, you're no longer getting interest. You do have a period of time where you may be able to put that money back. I believe it's 60 days, where if you have to kind of borrow, you can put that money back. But after you pass that time period, you're no longer able to contribute that same amount. You typically can't convert current accounts. So if you have a 401k that you have right now, you typically can't convert it. Now, with everything going on with COVID, there are some ways that you can kind of pull the money out if you want. So that is an option for anyone who may have money sitting in an account and they want to move it over. And you typically have to keep the money in a Roth for you have to keep it in the Roth for 5 years before withdrawal. You still have the 59.5 withdrawal age limitation with this. And if you want, you can move your funds to a self-funded pension account, which is a non-qualified annuity, and get tax-free income that you can't outlive for the rest of your life. Any questions so far? Okay. So tax benefits of the homeowner. So you get annual write-offs, interest, real estate taxes, mortgage insurance. You can write them off up to, I believe, $750,000 of the home costs. You get appreciation. So you have the house, you have to live somewhere. I always tell some people, you have to live somewhere. Typically, mortgages are cheaper than rent. The difference is, a lot of times, people will rent somewhere that they can afford and then buy a house that they really can't afford. Opposed to what I always suggest, I'm like, buy a house that you can afford, save the money that you need to buy another house, so you can then rent that other house out, and you have someone paying a portion of your mortgage, so you could still be paying the same amount that you were paying before, or less, or nothing. So, things to kind of consider, and that's also allowing time to pass for the value of that home to grow. So you're $250,000 if you're single, and $500,000 if you're married. Capital gain exclusion. So this is one of those things. If you sell your primary residence, you have to have lived there for 2 years out of the past 5 years. But if you sell your primary residence, you can get $250,000 tax-free, no questions asked. You can walk away with this money. Uncle Sam doesn't get any of it. If you're married, $500,000 on the sale of your primary residence. Who wants that? I do. So it goes back to also the planning. Make sure that if you're thinking about selling your house, you're doing it in that appropriate time period. Any questions on this?
Hey Chelsey, I had a question about the capital gains exclusion. Is the 250 or the 500K, is that a one-time, or is it kind of like accrued over a lifetime, or is it for each purchase or each sale?
It's more of a period of time. So let's say you were to sell your house that you lived in, and you lived there 2 out of the past 5 years, then you could get it. You have to wait another 5 years before you can do the same thing again.
Okay, so there's not like a rollover. If I stayed at one place for 2 years and then stayed at another for 3, and then I collected, let's say, 150 at one, and tried to collect another 100 on the second.
Nope, you get the 250 off of both, depending on how long you stay.
Okay, got it.
5 years pass, you can get 250 again. 5 years pass, you can get 250 again. So, very quick way, because like you're saving a lot on tax with that, so it's awesome. So tax benefits for an investor. You get annual write-offs. You get the interest in real estate, mortgage insurance. You still get depreciation. All that stuff is the same as your homeowner. Now you get rental income if you're renting it. Then you get depreciation, which helps write off the rental income because you're writing down the value of the property. And then you can get tax deferrals or exclusion for the 1031 or like-kind exchange, which you have to make sure you're doing this before you sell the property, because you want to properly move the money over to another property. But you're doing this, and you can continue to do that for your lifetime and get properties that are equal or better than the one that you have, and growing in value, and you get to start the depreciation over every single time you buy another property. Or opportunity zone investing. I absolutely love the opportunity zones. Thing that I don't love about the opportunity zones, unfortunately, is you have to have capital gains. You can't just save money and invest into an opportunity zone. It has to be from capital gains. But the good thing is it could be capital gains from anything. It could be capital gains from real estate. It could be capital gains from the stock market. It could be capital gains from the sale of a business. So there are different things that you can do to get that capital gains to invest in the opportunity zone. Now, there's a reduction in the tax that you have to pay on your initial capital gains. But if you maintain a property in an opportunity zone for 10 years, you get the appreciation on that tax-free.
Wow.
So, the example I like to use, if you were to take the capital gain from selling your primary residence, and instead of using it to buy another house, you take it and you put it into an opportunity fund. You have capital gain money that you're putting into opportunity fund. So while ordinarily you'd have to pay taxes on it, you have to pay taxes on this money now. You put it into a property that needs work. So you take this $50,000 property. You buy, maybe if you have $100,000, you get two $50,000 properties. So that was your initial investment. You take a loan to kind of renovate those properties, right? Now you force appreciation. You had 50, you bought it with 50,000. You put 40,000 into it. Now it's worth 150,000. So already you have $60,000 of equity built into it, or the equity is the amount over what you had to spend to get that property versus what it is worth now. So off the break, you forced appreciation to $150,000. Now, other people are doing the same thing because it's an opportunity zone. The point is to draw people to these areas to invest and to grow the areas. Now, other people are coming. In 10 years, this property is worth, let's say it's worth $450,000. Because so many people have come to make the area better. It's worth more, it's worth more, it's worth more. You walk away paying zero tax on that money. Now imagine if you've done that with several different properties. I'll leave that right there.
Can you do this with other people's money in opportunity zones? Other people's capital gains?
As long as it's, well, that's pretty much what the opportunity funds, that's what they're doing, and then I'm sure they charge a consultation fee, management fee.
So is there one developer for these opportunity zones and they're just gathering funds?
No, they're different ones. Like, you and I can start an opportunity fund today.
Yeah, that's what I'm trying to figure out right there.
We can start one tomorrow. Like, literally.
Yeah. Need to talk about that.
Okay.
Hey, Chelsey, sorry.
Oh, no, I was going to say questions.
Oh, okay. I did have one on the last slide that you had the investment. Sorry, I can't remember exactly what the slide said, but the first part of it had the real estate, the mortgage insurance. My question is there a way to still reap those benefits if you have a full-time job or if you're employed?
If you have the real estate, if you have real estate and you have a full-time job as an investor or as a homeowner, those are things that you get. You get the interest deduction. You get the interest. You get the mortgage insurance. You get real estate taxes. Those are things that you get, regardless of if you are a homeowner or investor. So yes, you can still get them as with a full-time job.
Okay, thanks.
Any other questions? I see someone put something in the chat.
I'd like to say one trick that I did when I got started going, and I mean, I wouldn't advise you to do this if you, once again, didn't do what she said and have your plan together, but I went to my employer and asked them to 1099 me under my company, so my money could start funneling through my business. And if you've been listening to what she said, for instance, you know, you can have your hair and makeup done if you have a wedding business. And I mean,
Or really?
I'm the type of person, nobody's going to tell me what my business does. that is a good example for you guys. I'm going to let you know what my business does, and we're going to write that off.
Like, as a real estate agent, there's a lot of things I'm like, I have to look a certain way. So I wasn't big on makeup and getting my hair done before, but since I've been doing real estate, I've been making sure I look more the part. If you're doing a lot of stuff on video, like if you're doing advertising via YouTube or Instagram or Facebook, and you're having to look a certain way, that's really part of what you need to make your business grow and thrive.
So Travis, when you had your employer 1099 you, did they also continue your benefits?
No.
Okay.
You lose everything. That's why I say make sure you know what you're doing before you do that. But, I mean, if you can know what you're doing with your money, that 401k is a great thing to have, but you can do the same thing with your own money.
And then a lot of times, too, when you go from a W-2 to a 1099, you're able to ask for more money because they're saving money on the benefits. They're saving money on the insurance. They're saving money on payroll taxes. They're saving money on different things that a lot of times you're able to demand a little bit more money.
Absolutely. I'll 1099 anybody, any day, anytime.
Any other questions, comments, thoughts, concerns? All right. Well, thank you guys. I hope the tax tips were helpful for you. And I'm going to kick it back over to Travis so he can kind of tell you guys what we have going on tomorrow.
All right, absolutely. I appreciate you once again for showing up for us on Topic Tuesdays. Tomorrow I keep always forgetting the topic, and I'm on this slow computer.
Turn on.
Yeah.
What is it?
Tomorrow's going to be money on my mind. So, just really talking about financial fear, like the fear that we have regarding our finances, also looking at our financial history. So, what is your history and your relationship with finances growing up and what you have right now? And what are your financial goals, dreams, ambitions, and what can we do to help you get there? So
that will be our lineup for tomorrow. If you guys would like to register your family or loved ones for that, they can visit hustlethenet.com/Wednesday. Once again, we do have different events going on Sunday through Thursday throughout the week at 8 p.m. And if you just visit hustlethenet.com, you will see how you can access those events and get your stuff on the list so you can get the emails as they come out to remind you about what we have going on here. Our mission is to get 1 million hustlers in here making $1 million. We think we can do this expeditiously. We just need a little education going on, and that's what we're starting to have here. Once again, we do appreciate each and every one for tuning in. Please make sure as you see the information pop up online that you like, share, and comment on that information. It doesn't cost you a dime. It just takes 2 seconds. But if there's nothing else that we have, I appreciate it, ladies, once again, and everyone who has tuned in yet again tonight. Have a good night.